Entity ABC Limited, whose functional currency is Indian rupees, sells products in France denominated in euros. ABC enters into a contract with an investment bank to convert euro to Indian rupees at a fixed exchange rate. The contract requires ABC to remit euro based on its sales volume in France in exchange for Indian rupees at a fixed exchange rate of 80. The question is this contract a derivative? Now, basically, ABC Limited is actually selling its products in France, and the customers in France are basically remitting euros to ABC Limited. All right, they're basically remitting euros to ABC Limited. So, ABC is going to receive euros, but ABC, being an Indian company, would want to actually have it in INR, would want to convert these euros into INR. So, therefore, ABC is actually entering into a forward contract with an investment bank. It's entering into a forward contract with an investment bank where it is agreeing to actually sell 1 euro at a fixed price of INR 80 rupees. All right, it's agreeing to sell 1 euro at 80 rupees. So basically, ABC will sell 1 euro and will receive 80 rupees. It is a forward contract to sell 1 euro at 80 rupees. All right, the question is it a derivative contract? You basically you have to evaluate whether the three conditions are actually getting satisfied. Condition number one is that the value of the derivative should change based on the change in underlying variable. All right, basically if the euro INR exchange rate fluctuates, ABC will actually make gain or loss. For example, in this case, ABC is actually selling 1 euro at 80 rupees. Let us say euro actually appreciates to 85. If euro appreciates to 85, in the market, 1 euro can be sold at 85 rupees, but ABC is obligated to sell 1 euro at 80 rupees. ABC is going to be obligated to sell 1 euro at 80 rupees. Therefore, over here, it is going to be at a loss. ABC is going to be at a loss because in the market, it could have sold it at 85, but it is actually selling it under this contract at 80 rupees. Therefore, it's at a loss. Alternatively, let's say if 1 euro is actually equal to rupees 72. In the market, ABC could have actually sold 1 euro at 72, whereas under this contract, it is actually able to sell it at 80 rupees, and therefore it is actually at a gain. All right, so as the exchange rate changes, as the exchange rate is changing, ABC's value of the forward contract, the value of the forward contract for ABC is also actually changing. When euro appreciates, then ABC is at a loss. When euro actually depreciates, then ABC is at a gain. All right, so the value of this forward contract changes based on the change in underlying variable. Underlying variable over here is the exchange rate. The second condition is there should be no initial investment, or the initial investment is supposed to be minimal. In this case, the initial investment, there is no information given, so it is presumed to be equal to zero. And generally, in case of forward contracts, initial investment is actually going to be zero as well. All right, so the second condition is also satisfied. Third condition is it must be settled at a future date. Again, the question is not explicitly mentioned it over here, but basically it is implied that at a future point in time, if it is making sales today, whenever it receives euro, let's say 1 month later, it is going to receive euros from its customers. So therefore, whenever it receives euros, ABC will actually sell the euros to the bank and receive INR. So the settlement is going to happen at a future date. All right, so it satisfies all the three conditions of the derivative. It satisfies all the three conditions to be a derivative contract, and hence this will be considered as a derivative contract as per Ind AS 109. What is the implication of actually considering this as a derivative contract? It basically means that on each balance sheet date, this contract will be reflected at fair value with all the changes in the fair value being taken to P&L. Once the contract satisfies the definition of derivative, you are required to measure the contract at fair value on each balance sheet date, and any gain or loss should be reported in P&L account. That is the implication. All right. So that is with regards to illustration number 4.